እንዴት ናችሁ ቤተሰብ ሁሉ ሰላም ደህና ናችሁ? How are you all are fine? I am fine, thanks for God. So this is fundamentals of accounting chapter 1 about inventories. So every student should know about the inventory concepts, its meanings and its definitions in accounting. So the accounting for inventory is very important in accounting. So it is a major consideration for many entities because of the significance on both statement of profit and also on financial positions or as on the cost of goods sold and as a statement of financial position, as we say. So this is a very important concept. You should have to know inventory. So there are two types of entities, as you know. The merchandising entity and the manufacturing. You know that, okay? You learn in fundamentals of accounting 1 also. So merchandising entity and manufacturing entity. So generally merchandising entities are retailers or wholesalers has a single inventory account. So usually entitled merchandise inventory, we can say they have only merchandise inventory. Okay, they have only single merchandise inventory. It is not doubles. Okay, it is not as manufacturing entities. Okay, those goods on hand that are purchased for sale only. Okay, in merchandising, the inventories are only for sale. So inventory means the material which is filled for sales. Okay, as you know, when we say inventory, it is materials or the goods which is held for sales only. Okay, so the other types of entities, a manufacturer, which generally has three types of so manufacturers have three types of inventories. Okay, as you know, as you learn in any accounting courses, raw materials, work in process, and also finished goods. You know it is their definitions also. So generally, those are very important concepts. Then when we say the raw materials, as you know, raw materials means inventory represent the goods purchased that will be that act as inputs. They are inputs. Okay, they are inputs in the production process leading to the finished good. So if we have no input, we have no finished goods. Okay, without input we cannot talk about finished goods. Okay, those are the input which is leading to the finished products. Okay, then then the raw materials are go to work in process. Work in process means consist of the goods entered into the production, but they are not completed. Okay, they are not completed, but they are not. The goods are entered into process, but they are not completed. Okay, so when we say finished goods, inventory is completed. Okay, the inventory is completed, but not yet sale. Okay, they are on hand. Okay, they are on hand. Okay, inventory that the completed product that is on hand, awaiting for, they are awaiting for sales. Okay, they are not sold up to now. So like that, you should have to understand importance of inventory. Is known. Okay, merchandise purchased on and sold is the most active elements. Okay, they are the most active element in merchandising business. That is In the wholesale and the retail types of business organization, especially it is very known due to the following reasons. Okay, for example, the sales of merchandise is the principal source of revenue for them. Okay, it is the biggest or the large source of revenue for those merchandise business. Okay, the cost of merchandise sold is the largest reduction from the sales. Okay, the big source of revenue, the cost is also the largest deductions. Okay, for those business organization. Okay, they have high cost to sell those materials. Then inventories, ending inventory is the largest of the current asset. So the ending inventory is the very largest. Okay, the largest current asset of those firm. It is the largest. Okay, the largest current asset of that firms. Like that, you should have to understand. So inventory is very important. You should have to know your inventories. Okay, your inventory is okay your biggest asset. Okay, your the largest. The cost that should have been made on that is also high cost. Okay, so the ending inventory is the largest current asset for that merchandising field. So because of the above reasons, inventory has effect on the current and the following price. So for those reasons, it have effect on the current and also on the future financial statement of the that its own effects for those. If inventories are misstated, okay, if the inventories are misstated, or it may be misstated by understated, or it may be overstated on the financial statement. So this this will distort financial statement. ስልክ የኙ ደወል ቆይሮ ኮንቀው በኋላ እንትን so this is very important point. So next to this, you should have to now we should have to talk some concept related with inventory costing systems. So according to International Accounting Standard number 2, the primary base of accounting for inventory is cost. Okay, it's the primary base. Okay, cost. Okay, you should have to know cost is defined as the sum of all costs: cost of purchase, cost of conversion. Okay, we purchase material, we convert material, and also other costs incurred which bringing those inventories. Okay, the cost which bringing those inventory to this place. Okay, to this current time are okay generally cost. Okay, they bring those materials to these locations. Okay, those are a cost. Okay, it may be cost of purchase, so it may be conversion costs, and also there are other costs. There are many costs. Direct, we have a cost like direct and indirect cost of materials generally. This is significant interpretation of the cost to be included in inventory. Okay, they may be included in inventory generally. Cost of conversion and also cost of purchase are very important costs you should have to know in accounting. For raw material in the merchandise inventories that are purchased outright and not intended for further conversion, some materials are not purchased for further conversion. They are purchased outright. Okay, the identification for cost is relevant. It is relatively straightforward. Okay, the cost of this purchased inventory will include all expenditures incurred in bringing the goods for the point of sale. Okay, up to the point of sale, we have a cost. And putting them into the saleable condition. To put those materials to the saleable condition. Okay, up to that we have a cost. Okay, we have a cost. So straightforward costs. Uh, they are maybe not intended for conversion. We cannot convert them. Okay, directly selling for them. Okay, so the cost that we have is about the cost putting those materials to the saleable conditions. The cost of purchase inventory will include all expenditure incurred bringing the goods to the point of sales. These costs include purchase price. Okay, we purchase it. Okay, we import duties. Okay, and other tax, maybe tax cost. Okay, import cost of a purchase price other than those subsequently recovered by the entities from the taxing authority. Maybe VAT. Okay, VAT, uh, transaction costs, insurance, and handling costs. Trade discounts or rebate and other such items are to be deducted in the determining the inventory cost. Failure to do so when the result in carrying inventory at amount in excess of historical cost. Exchange the differences arising directly on the recent acquisition of inventories invoiced in a foreign currency are not permitted to be included in the cost of purchase of the inventory. Exchange difference arising directly on the, so this is very known as you learn in fundamentals of accounting one. Borrowing costs will be generally not be capitalized in connection with inventory acquisitions, since the freight required to ready the goods for sale will generally not be significant. The time is not significant. So the borrowing cost will generally not be capitalized. We cannot capitalize it away because sale will generally not be significant. On the other hand, while lengthy production process is required to prepare the goods for sale, the provision of international accounting standard would be applicable, and the portion of borrowing cost would become part of the cost of inventory. Okay, when the length of time is required. Okay, when the length of time is required. In practice, such fish are rare. It is very rare. Okay. The other one is conversion costs for manufactured goods should include all costs that are directly associated with the units produced, such as labor and overhead costs. There are direct and indirect costs when we convert that materials into productions. Okay. The allocation of overhead costs, however, must be systematical and rational. The allocation of cost must be rational, or it must be systematical and rational way. You should have to allocate your overhead costs systematically and rationally. And in the case of fixed overhead costs, those which do not vary directly with the level of production, the allocation process should be based on normal production level, since it is when it is fixed. Okay, cost other than material and the conversion cost are capitalized only to the case when they are necessary to bring the goods to their present condition in the locations. Okay, maybe for example, examples may include sustained design cost and other types of pre-production expenditures intended to be benefit specific classes of customers. On the other hand, all research costs and most development costs would typically not become part of the inventory costs. Okay, they are not inventory costs. Okay, research and development cost is not included. The other one is ownership of goods. Who is the owner of these materials? Who is the owner of these materials? Who owns these goods? So inventory can only be an asset of the reporting entity. Okay, when we say inventory, it is an asset of reporting entity who report it if it is an economic resource of the entity as the date of the statement of the financial policy. Okay, so since the date is known, in general, an entity should record purchase and the sales of inventory when legal title is passed. Without legal title, okay, should have to not recognize or record the asset, okay, those properties. All those strict adherence to this rule may not appear to be important when there is some strict rules. So, okay, the strict adherence to the rule may not be approached. So, proper inventory cut off at the end of an accounting period is crucial. It's very important for the correct determination of the predict result of the operations. Thus, for accounting purpose, to be obtained an accurate measurement of inventory quantity and the corresponding monetary representations of inventory and the cost of goods sold in the financial statements, it is necessary to determine when title passes. Okay, when title pass from the very beginning, we say that in general an entity should record purchase and sale of inventory when the legal title is passed. Without the legal title, it is not your inventories. Okay, the most common error made in this regard is to assume that the title is synonymous with the positions of goods on hand. This may be incorrect in two ways. Okay, the goods on hand may not be owned. The goods on hand may not be owned, and the goods that are not on hand may be owned. Okay, these two are incorrect terms. Okay, okay. These are four matters that may be cause confusion about proper ownership. The goods is in transit, consignment sales, product financing arrangement, and the sales made with buyers having generous or unusual right of return. But for the sake this course, as an introduction, we will see the first two concepts. Okay, so when we see goods in transit, for example, goods in transit are goods purchased, goods not yet received, and the sold goods not yet delivered. This is in transit. Okay, the goods are in transit. They are purchased, not yet received by the firm, and they are sold, okay, but not yet delivered to other firms. Okay, goods in transit should be included in the inventory of the company that has legal title to the goods. Legal title is determined by the terms of sales. Okay, there are many terms of sales, as you know. The term FOB stands for free on board of this. Okay, if the goods are shipped free on board destination, the seller pays the transaction. Okay, when it is free on board, the sellers pay the transaction cost, and the title does not generally pass until the carrier is delivered to the buyers. Thus, the goods are part of the seller's inventory. While in the it is the seller's inventory now. If the goods are shipped for the shipping point, the transaction costs are paid by the buyers. Okay, it is the buyer's inventory now. Okay, so those two concepts must be known by the students. The term of FOB destination and FOB shipping point often indicate a specific location at which title to the goods is transferred, such as FOB Ethiopia, FOB Milan, FOB in other, okay, some place, okay, or the firms, okay. This means that the sellers would most likely retain title and the risk of loss until the goods are delivered. The risk is for what? For whom? Okay, until the goods are delivered to a common carrier in Milan who will act as an agent for the buyer. Okay, like that you should have to understand. In cost insurance and the freight, there may be cost insurance freight there is also cost insurance freight contract. The buyer agrees to pay lump sum cost of the goods, insurance cost and the freight. ለምሳሌ the buyer agrees to pay lump sum cost, insurance and freight. Okay, so it is covered by the buyers. In cost and freight contract, the buyer promised to pay lump sum that in the cost of the goods and all freight charge. When it is C and F, cost and freight. Okay, that's very important. The other one is consignment sales. That means the transfer of goods by one party. Okay, one party transfers the goods. He is known